Hello, my name's Angus Murray. I'm the CEO of Castlestone Management. I was going to go through a presentation here on Aliquot Gold Bullion. This is a fund that owns physical gold, 100% of it stored primarily in allocated accounts with Barclays, meaning that the bars of gold sit in a vault with our very own name on it, not on the balance sheet of Barclays. We have been advocating for the course of the last 10 to 12 years the reasons why people should own unleveraged real assets. And of course, gold is the primary or easiest to understand unleveraged real asset. And the primary reason for that is the ongoing devaluation of money. As the value of money falls, the cost of living rises, be that electricity, be that food, be that petrol, and ultimately the cost of living is rising as the value of money is falling. Therefore, as a consequence, when you talk about production costs of things like gold, which are made up of elements such as labour, where people require an increase in salary to be able to afford those things, it results in the cost of production rising. And because we are now in a world of increased transparency and disclosure, we can get a much better idea from the mining companies what their actual cost of production is. And as you can see here on slide 3, the cost of production of gold bullion is $1,300 an ounce. What that means, if the price of gold falls below $1,300 an ounce, then the gold mining companies are going to cut back production or go out of business. And given we have constant demand coming through, we will see the price move back above $1,300 an ounce, and the price will continue to rise with the devaluation of money, just as it has, and you can see it on this slide, since the course of 2007 and going back further. So what is this fund? Simply 100% exposure to physical gold, as I said, primarily in allocated accounts held with Barclays. We can see that the cost of production as a breakdown for Barrick Mines being one of the highest efficient producers of gold bullion is that the labour costs are 25% of production costs and capex is 28%. These numbers are impossible to lower. The other important point that I think that comes across is that mining companies have spent approximately $45 billion on acquisitions and exploration since 2010, but the actual gold production has declined. And of course, at the same time as investors continue to add gold to their portfolios, we've had central banks going through the process of adding gold bullion to their portfolios, and we believe that is likely to continue. So this fund, as we indicated, really is associated with the cost of production. You can see here the all-in sustaining cost of production of some of the major mines. You can see Newmont versus, say, Goldcorp, but the average is coming out at around $1,300 an ounce. We put this slide in here as a new slide just to advocate the view that a devaluation of money has a direct effect on the cost of production. And you can see here, as I indicated, Barrick Gold Mines, they're all in sustaining cash cost 2012, that labour represents 25%, and you can see the sustained capex at 28%. Obviously, if you get a devaluation of money, a number of these elements are directly affected by that devaluation of money, which leads to a higher cost of production, which must lead to a higher price ultimately for gold bullion. We put slide 6 in here just to indicate that although we haven't reached it yet, we are going to see a tapering or a slowdown in the amount of quantitative easing which is occurring. Obviously, if a central bank creates or prints more money, it does only amplify out the devaluation of money that occurs over a period of time. What you can see here is if the Federal Reserve were to continue to go through a $85 billion per month purchase, what could theoretically happen with regard to the price of gold versus a tapering that was to come about. What we think is likely, though, is that as central banks continue to print money, and obviously the European Central Bank cutting interest rates just in the last couple of weeks would indicate that the economies do need this ongoing process of printing money, that we are going to continue to see a devaluation of money. Hence why over a period of time the gold price will continue to rise. We put slide 7 in here just to remind people of what happened in 2008 with regard to gold being a safe haven based asset class. It was one of the reasons we stated to own gold bullion back in 2002, 2003, even though the primary reason was a hedge against the devaluation of money. Obviously gold is seen as a safe haven based asset, and that continues to flare up each time we end up with problems, be it in equity markets or in geopolitical risk. As I commented before, central banks continue to add gold to their portfolios to diversify their risk. You can see the substantial turnaround from central bank selling of gold bullion up until the end of 2009, and then the purchases that came about in 2011 and 2012, and where we stand with regard to the approximate purchases in 2013. We think that is likely to continue. Slide 9, just talking about where consumption comes through. If nothing else, you're not going to give your girlfriend a copper ring, or certainly she won't want to receive anything else but gold and probably platinum, to be honest. But what we are left here with is that as you continue to get an increase in the GDP per capita of major economies such as China and India, they continue to consume more gold, even if it is done for jewelry, but also a store of wealth. And there is obviously a correlation between that and the gold price. If we were able to produce substantial more amounts of gold at relatively cheap prices, that correlation would break down, but that is not going to occur. So this correlation will broadly be linked for a number of years ahead. Slide 10 is going back to that comment with regard to the ability to mine or find more gold. You can see the enormous increase in gold exploration that has occurred in the world, and yet you can see the resources in terms of discoveries that have been coming through, and we are basically not finding any more major discoveries in terms of gold. Therefore we can mine what we've got, but it is now down very deep. The deeper it is, the more it costs. The higher the cost, the higher price of ultimate gold we would have to be achieved in the marketplace to justify those companies producing the gold in itself. If the price isn't high, they'll cut back production. Given the same level of demand, you'll end up with a higher price. And obviously one example of that is the unrest we continue to see in the South African mines at the moment. That really is because, in the true sense of it, the miners' salaries have not kept pace with the devaluation of money and the increasing costs of living standards in South Africa. And that directly affects gold bullion. It obviously directly affects platinum as well. Slide 12 here was to reiterate a point we made over 10 years ago. That is that there was a major difference between gold, being the physical bar of gold, and a gold mining stock. In this case, we've used the example of Barrick mines, principally because it's one of the better, more efficient and larger of the mining companies listed in terms of production of gold bullion. And you can see that back in 2002, where we've put both Barrick Gold's share price and the price of gold, you can see the substantial and meaningful difference that's come about 10 odd years later. Barrick is back to the same price, whereas you know gold has risen from around $350 an ounce today around $1,300 an ounce. In terms of weightings, we would indicate that a 10% allocation to gold is quite sensible. Obviously this has been the physical gold for the hedge against the devaluation of money, and also the safe haven based asset class status that gold holds in the mentality of most investors. So a 10% overall weighting is certainly a practical, sensible thing for people to have today. The fund that we're managing is in dollar, euro, sterling. We hedge the currency. The gold is primarily in allocated accounts, meaning bars of gold held with Barclays, and therefore not on the Barclays balance sheet. That is no negative to Barclays, it's just indicating it's a vault rather than it being anything else in terms of the storage of gold. We are going to be moving our gold bullion fund from weekly traded to daily traded. Given the underlying asset is completely liquid, it makes no difference to the fund, but nevertheless that is just us continuing to highlight our willingness to want our liquidity of our funds to be as liquid as possible, the transparency to be there, easy to understand, easy to comprehend, and easy to explain. So in terms of the reasons why owning gold bullion, as a summary, first of all, Aliquot gold bullion, it's 100% direct exposure to physical gold. The production cost of gold, which I think is the main point associated with the devaluation of money, $1,300 an ounce. Central bank holdings continue to increase, and yet we are not getting the same increases in production coming through. Gold mining companies having spent $45 billion on projects and acquisitions since 2010, but actual gold output has declined. And the fact that we've been advocating this as a strategy view for the last 10 years, I think only goes to highlight the usefulness of some of the comments that we do actually make to our investors. If you need anything further with regard to that, by all means, please see our distribution staff, or alternatively, any of the investment managers are here that can help you and discuss that. Thank you very much.